officially welcome everybody here to our meetup. Glad to have everybody here. And tonight we're going to just be shooting the breeze about multifamily and hopefully we can all learn from each other a little bit and, find out what everybody's into and go from there. But so, to start off with, my name is Bobby Jones. I am a retired nurse anesthetist. So a couple of years ago, I started investing passively in multifamily syndications and was able to produce enough income from that to essentially be able to walk away from my position in anesthesia. So, I don't make what I made in anesthesia. It wasn't about that for me. It was more about having my time back. And so I was able to become a stay-at-home dad. And of course, that helped out a lot during the pandemic. During that time, I've, been in around, I guess, 9 passive syndications now, and a couple of active apartment syndications as well. So, glad to be here and to have everybody else here. So I don't know if we want to go around. I know, Erica, you kind of introduced yourself to me a little bit already, but if you wouldn't mind kicking us off here and just introducing yourself to everybody else.
Okay. Well, hi, guys. My name's Erica. I come all the way from sunny South Africa. I lived in Miami for 2 years, and now I find myself in Raleigh, North Carolina. So right in the South, which is wonderful. And I'm looking forward to see how you can create passive income and kind of stop exchanging time for money.
Absolutely. So, Michael, you're up.
I'm originally from New York. I'm currently in Virginia, Christiansburg, Virginia, and interested in finding out more. I do 3D animation, freelance stuff, and looking for other ways to subsidize my income, increase.
Very cool. Very cool. So, Nathan, good to see you again, buddy.
Yeah, nice to see you again. I'm from Louisville, Kentucky, and my wife and I opened our business last year. We are syndicating for multifamily properties, and we're looking for about 30 to 100 units. And markets that we're focusing is Kentucky, Carolinas, and Texas.
There's some good markets. Are you looking specifically in certain cities in those areas, or?
Yeah. So like Kentucky is like Louisville, Georgetown, and Lexington.
Okay.
And Texas is like the Triangle, so like Houston and Dallas, and then in the Carolinas around Charlotte and Durham, as well as like Greenville, and then the third markets there too.
Yeah. Very cool. I haven't gotten much into Greenville. I know it's, all these markets, they can all be a little tricky at times. So I'm not as familiar. I live near it. I know it's a college town. It's got East Carolina University there, but I'm not as familiar with the actual, multifamily world there. But I have heard some people having some success there. So cool, man. Well, good to have you here. Angela, we're just kind of introducing ourselves a little bit here, and good to see you again. I know we saw each other a little bit earlier today.
Yes, we sure did. Yep, thanks. I was having trouble signing in. I got in a different group. I'm like, wait, this is the right one. Where's Bobby?
It happens. I mean, I had one of these meetups, and I had sent out the wrong link to everybody, and it's like, people were, I can't get in, and sorry, that was my fault. Yeah, I'm sitting here by myself for a little while. I'm like, what in the world is going on? But, hey, that happens. So, but if you wouldn't mind just telling everybody a little bit about you.
Yep. So my name is Angela. I am from Summerville, South Carolina, which is near Charleston. I do insurance, and I'm starting to get into insuring the multifamily properties. Getting into that avenue and trying to learn as much as I can from you all. So
very cool. Very cool. Well, and MB, I if you wouldn't mind, you don't have to, but you can unmute yourself and introduce yourself. And you don't have to turn on video or anything. And if you would rather just type in the chat, that's fine too. I know some people come into these calls and they're obviously dark for a reason, whether they have a screaming kid in the background or what, but yeah, we'd love to hear about you if you're able to. But otherwise, we'll just jump into it. So, I know something that's been talked about a lot lately is the inflation stuff going on and how that's affecting the multifamily loan rates and things like that. And so I was curious, if and I guess this is a good question for Nathan and Angela, if you got what you guys have seen with any kind of multifamily, if you've seen any real changes with that yet. I have my own thoughts about it, but I'd be curious to see yours.
So I was talking to some of my carriers this week, just asking them, what kind of percentages increases, and they all kind of laughed at me like, well, we can't really, predict that, but it could be, some of them have been as high as 200% in increases for insurance wise.
Yeah.
That's obviously the extreme, but
yeah,
nobody wants to see that bill come in. So
no. Well, that definitely affects your underwriting when you're looking at a property. So, and for, Erica and Michael, I know you guys kind of mentioned that you're newer to this, kind of thing. So, there are a few different ways to go about investing in multifamily properties. The one that a lot of people hear about is, investing in duplexes, triplexes, and quadplexes, and kind of building up your portfolio that way by having your own individual investments. Those are great ways to get started, and you can certainly, do that with less amounts of capital than some other types of investment methods. But as we're seeing all real estate being lifted up and prices go up for everything, it's actually starting to become almost cost prohibitive to do that, because if you have a duplex and it's 300,000 for let's say 400,000 for simplicity's sake, then you got to come to the table with 100,000 to get that loan, and that's often for a lot of people that's tough to do. Whereas the other way to invest and to do it more passively is to be a limited partner in an apartment syndication. And so an apartment syndication is basically a group of investors getting together to take down a bigger property. So let's say you have a 100-unit apartment building. The cost of that building might be $4 million. So you need to raise $1 million to buy it. Okay. And I'm just throwing numbers out there. They don't really mean anything right now, but so you need to raise $1 million. So investors, chipping in 50,000 a piece, sometimes, as low as 25,000 a piece, can get in to the ownership of an asset like that. And so what happens is you have operators who are on the active side, and they are the ones who actually go out and they find the properties and they present the properties and the business plan to you as an investor. And that they give you the opportunity to invest in order to get certain returns. And that's essentially what I did. Was I invested as a passive investor or limited partner in those kinds of investments to produce passive income. So, with my story, it was a little drastic. I took money out of my retirement accounts and I paid the penalties on them, and because I wanted the passive income now. For other people that don't want to be that drastic, you can use retirement accounts, self-directed accounts, to invest in those as well. And the money that you get, the distributions and all that, the returns, they go straight into your retirement account. So that's a nice way to do it and to give yourself some diversification. You can also just invest with cash that you have on hand. If you have a savings account or something like that, you can invest that way. But in those ways, typically what you get, the passive income that I get is anywhere between 6 to 8% returns per year on an investment. So let's say I put $100,000 into an investment, then I'm getting $6,000 to $8,000 per year in passive cash distributions from that. Okay. And that's for the duration of, the time that we hold the property. And so the management team goes in and they go start renovations and they, try to increase the value of the property. And when they're able to do that and they're successful with that, then they're able to sell the property to somebody else and at a higher value. And that's when you get the rest of your returns as an investor. So you'll get 6 to 8% from there. You'll get the rest of it on the sale. So that's kind of how that works, just in very glossed over nutshell. So does that make sense to you guys? I'd love to hear questions from you guys on on any of this stuff, because I do know that it's kind of like drinking water from a fire hose at times.
Bobby, how difficult is it for a non-qualified investor to get into a syndicate?
So that's a great question, because there are, generally speaking, two types of investors. Okay, there are accredited investors, and there are
That's it.
Yeah, or non-accredited / sophisticated investors. Okay, so to be an accredited investor, it is just a matter of wealth. It has nothing to do with your intelligence level or your experience or your education. Nothing. It is all about your wealth level. So you are qualified as accredited if you make individually over $200,000 a year for 2 consecutive years, or $300,000 jointly with your spouse, or if you have $1 million in net worth. Okay, and and we have validation processes for that, where you go and you talk to the accountants, and you can get somebody to sign off on that. There's Cinto. We're going to try and get you back in here again. So basically, that's what it means to be accredited. And the reason that term came about was because the idea that the SEC had was that they wanted to protect these little investors from getting into these risky types of investments. Now, if we're being honest, multifamily is about 3 to 4 times less risky than the stock market. So it really doesn't make sense. And you can invest in penny stocks all day long, which have much, much higher risk than, anything else on the stock market. So the idea that you have to be accredited to invest in these types of investments is kind of ridiculous. But so I want to say, well, I'm going to get my dates wrong. So needless to say, within the last 10 years, they introduced the idea of sophisticated investors. Now, these are investors who do not qualify as accredited. And I was in this situation 2.5 years ago. My wife and I did not have the net worth of $1 million. We did not make $200,000 to $300,000 combined. Okay. So there are different types of investments that you can invest in as a sophisticated investor. So those are called 506B investments. And basically they take on, they're allowed to take up to 35 sophisticated investors in those types of investments. So that's the general idea with that. Now, if you're accredited, you can invest in anything you want to. You can, if you see a deal come across, you can invest in it. But there are certain deals that are for accredited investors only. Okay. And so those deals, if you are sophisticated, you simply cannot invest in them, because there's a verification process involved and you would not pass that verification. But that's kind of the short story of it. Does that answer the question?
Yes. Yep. Okay.
And yeah, for you folks who are a little new to this, I know there's a lot of terminology here, so please pipe up with any questions. I also do have my YouTube channel, which I will link to in the chat, and you guys can check out. I have a ton of educational videos and content there, so you can kind of learn at your own pace with that kind of stuff. So I'm more than happy to share that. So, and guys, yeah, we do have a chat here. If you want people to connect with you, these are all about networking too. So, put your content, your contact info in the chat, so that people can reach out to you and connect, and we can all learn from each other and get better at all this together. So, but yeah, essentially, so what I do as an individual is I have my own company, and I work with operators that work in the multifamily and other alternative investing spaces to try and work on deals to provide to investors. So we have both 506C and 506B deals. So we have deals that are for accredited investors only. We have deals that can include sophisticated investors. It just depends on the deal itself. But that's kind of how I try to do it. And my goal is to provide access to, all types of different investments. So I don't just do multifamily. I'm also, looking at self-storage. I'm looking at, Airbnb, all those kinds of things to try and provide those kinds of opportunities to people. wherever it makes sense. So, but yeah, as far as, getting into these as a newbie, like I said, there's different ways to go about it. You can start off and start building your own portfolio. A lot of people that get into owning their own properties, duplexes, tris, quads, whatever, they get into it with the idea that it's going to be passive. And a lot of times it doesn't always work out that way, unfortunately, because you do have to create systems, put systems in place to try and make it as passive as possible. But at the end of the day, you own the property, and unless you've hired a property management company to specifically run that property, then you're going to be running that property and checking out tenants and things like that, vetting everything. And if there's something that goes wrong, you are responsible for fixing it. So when I talk about apartment syndications, I compare it to investing in the stock market. Buying an individual stock like, Amazon or Facebook, you get a share of that company. Because when you invest in apartment syndication, you're not so much investing in the property as you are in the operators, because the operators are the ones who make or break the offering. So that's where it's really important to vet the people that you're investing with. But if you vetted them properly, this is truly the most passive investment around. Those operators will carry out the business plan in the time that they're supposed to. They communicate with you about what's going on. They provide you with all of that information, and you get your cash distributions on time and in sequential fashion. So it can work out really, really well. And I've had that happen for me. I had, most of the deals that you'll see set up, they're over a 5-year timeline, 5 to 7 year hold period is what it's called. And so, the 5-year hold is pretty standard, and they're typically aiming to, come close to doubling your money over that time period. So if you invest 50,000, you're looking at a 2x multiple. They're looking to turn that 50,000 into 100,000. Okay. That's the goal. But of course, you kind of want to undersell and over deliver. So for instance, 2 of the first 4 investments that I had, just this last fall, they actually turned over. And they have already sold, and I made nearly double my money on those in just a 2-year time frame. So what I did with those investments is I started the snowball effect. I 1031 exchanged those investments into new multifamily investments that will continue to yield passive income. But the 1031 exchange allows you to defer your tax burden, so you don't have to pay capital gains taxes. You can continue to defer that and just snowball those profits into the next investment. So it's a really nice thing to be able to do, and it allows you to really accelerate your cash flow. So the first couple of investments that you make, you're not going to be making millions here. This is not a get rich quick kind of thing, but my income as a result of those 2, investments turning over, my passive income is, by the time those start up here in the summertime, my passive income will go up by $1,000 a month. That's pretty cool. I'm pretty happy about that. And then I've got 2 other deals that hopefully will be close to a cash out refinance. The goal of these operators is to get you your money back as fast as possible so that you can start this snowball process. So typically the operators will do their best to complete as much of the business plan as they can in the first 2 to 3 years. And then either they will look to sell the property at a profit, or they will look to do a cash out refinance, which is a non-taxable event for you as an investor. So you get a large chunk of your initial capital back that you can then redeploy. And you're still in that deal. So you're still getting the cash flow from the first deal, but now you're in a second deal. And so that's how you really start this process going. So
how did you go about vetting your first operators when you initially?
That's a great question. So it's, for me, a lot of it is about relationships. Mm-hmm. So I want to have conversations with the people. first. If I'm looking at their investments, I want to have conversations with them. I want to be able to pick their brain about what they're looking to do. But also you want to look at track record. I mean, that's one of the best signs that you can have that somebody has experience to be able to deal with the bumps in the road that are going to come along the way. So, and that's the thing right now. There are a lot of newer operators that maybe don't have the track record. That doesn't mean they're not going to be good. That's not it at all. Then you have to look deeper into, well, where is their support coming from for this venture? Do they have mentors that they're leaning on? How much are they leaning on those mentors? Or is it a mentor in name only, and that person's not going to be around once, things really start to go? Now, most people who are mentors won't attach their names to something just to attach their names to something. So that's a good thing in our industry. Most people, if you put your name on something, you want to make sure you're representing yourself well. But, you just have to check the track record, and you have to see what kind of returns they're giving to previous investors. You can have conversations with other investors that have invested with them. You can request that kind of a conversation and that contact information. A lot of sponsors will give that to you. But just looking at their track record, looking at making sure that your goals align with theirs. There are operators who are more in it to try and make a quick buck, and and I don't say that to be mean or anything. It's just, that's we're all here to try and make a profit. And, but some people, some operators, their goals will just align more with what you're looking for. So, for me, I really am excited about improving communities. I want people, operators that want to go in and legitimately change a place for the better. If you're looking to go in and just renovate properties, just for the heck of it so that you can drive rents up, well, that's great. You'll make a profit and that'll be great. But I like operators who go in and they're like, we got this vacant space. I'd really, let's put in some barbecue stations and, a dog park and a playground for the kids. Cause this is a neighborhood that, the kids have to go cross a couple of streets to get to the nearest neighbor, to the nearest playground, but we can provide them a playground right here and make it safe for them. It's that kind of thinking that I appreciate, because it's what I would want to do if I really owned the property myself. I would want to make it a better space for people. So, the thing about apartment syndications is it should be a win-win-win for everybody. The investors should be able to invest with confidence and know that they're going to get a certain return, or at least that their money is going to be taken care of as well as it possibly can by the operators. The operators can make improvements to a property and they can profit, when the property's sold. And then you've got, the residents themselves who stand to benefit as well, and so if you've got a better place to live and you're now in a better community, that, now you've got some community events, you got the food truck that comes by once a week, and everybody in the community comes out and they know it's going to be a little bit of a get together. You get to meet people that way and create that community. It becomes a safer place. It becomes a better place for everybody. And residents who want to stay there are willing to possibly pay a little bit more to do so, because they realize that they're getting such a great value out of it. So, like I said, it can be a win-win-win for everybody. And that's really what I look for when I'm vetting operators. But again, yeah, you want people, you want to make sure that they've got the right team in place. So you need to, they need to be underwriting properly. And I say, every operator you talk to will say that they underwrite conservatively. Okay. That's just the name of the game. Everybody wants to say that they're conservative. Okay. That's great. As a passive investor, you need to see some deals come across so that you can get an idea of what these things actually look like. And you need to get, into the idea of kind of teasing out certain parts of it. If there's just so much to it, it's kind of hard to, it's kind of hard to just pin down specifically. But certain numbers, like if you're looking at rent numbers, rent increases and stuff. Okay. Now, let's say we're just looking at the Atlanta market. Okay. We know Atlanta is a hot place right now. Okay. As are many places in the Southeast, but we'll go with Atlanta. Rent increases in Atlanta are probably in double digits, and have been for every year. Now, if you look at an underwriting, at a deal, and they have underwritten that the rents are expected to continue to increase by double digits over the first several years of an investment, that's not conservative underwriting. Okay. That's assuming that everything's going to continue on and the gravy train keeps rolling. And it's easy for things to work out when everything keeps rolling that way. But if you've done all of your numbers based on something like that, and then all of a sudden we hit a recession and those rents aren't going up at that same pace that you underwrote for, then all of a sudden your investment could be underwater. So if I see, in a market like Atlanta, I see them projecting 5%, 3% rent growth in the first few years. Well, that to me shows, hey, they're being pretty conservative here. Okay. That's just one example of that. You can also look at loan to value and where your break even points are for an investment. If your break even point is, in the 70th percentile with regards to occupancy rate. So basically, if you have 100 unit property and your break even point is if you have 75 people, 75 of those units rented, that's actually kind of a high rate. You'd rather that be 70 or below. So they might be running things a little leaner than you would want if it's at 75. And that gives you less room for error there than some other investments, which might be around 65. And that just means, that's the break-even point where you've got enough money to pay the bills. That's all that means. If you have 65 of those units rented, then you've got enough money to pay the bills. You can cover your debt service, you can cover everything, you can cover staff, everything. You may not be making money, but you're at least not losing money. Okay. So the lower that break-even point is, the better off you are. So that gives you more room for error on your investment. So those are all things to kind of look for when you're looking at your own investments. And you also need to figure out why you're investing, what your particular strategy is, because there are tons of different asset classes and asset, prices and all kinds of things. So, and there's all kinds of structures for deals. So some are cash flow heavy, where you might get 8 to 10% cash distributions every year. But they're not expecting a huge appreciation because maybe you're investing in, a tertiary market somewhere. They're not expecting that huge appreciation like you would in some of these bigger markets. Or you could be in something that's more of like that fix and flip kind of mentality. And hey, we're just going to go in, we're going to fix this thing up. We're not going to give a whole lot of cash distributions because we got a lot of renovations to make. And we're going to give you some cash distributions, maybe 4 to 5%, but we're going to make it up on the back end and we're going to give you a big old return on the sale of that property. That's fine. If you've got time on your hands, you're not worried about the passive income, then that's a fine investment to get into. If you're worried about passive income, then maybe you need something that's got higher cash distributions. If you're worried about different things like, the asset class, I don't personally invest in Class D properties, which are, like Section 8 properties and, things that are in kind of bad neighborhoods. I just don't want to be worried about a bunch of shootings at my properties and, like crime and all that kind of stuff. It's just not my thing. You can make money on those investments as long as your operators know what they're getting into and as long as they build that into their business plan. But personally, I'm not willing to take that kind of risk on. There are some people, I know some who only invest in Class A assets, creme de la creme, brand new construction. I'm not that way. I like A, B, and C. I like to spread it around in my portfolio. For instance, I have investments in all three of those kinds of classes. I have investments in the Carolinas, in Iowa, Idaho, Colorado, and Alabama, and Texas. So, I spread mine around for that true diversification. And that's what I try to do with my investments. So it's not for everybody. Some people invest only in the market that they live in, or in the markets that they are incredibly well versed in. And that's another thing too, is if you know a market, that allows you to spot something that seems off in a deal. So just keep that in mind for when you're first starting out. You may want to invest in markets that are nearby that you feel more comfortable with. So now I'm doing a lot of the talking here. I would love for somebody to come in and give my throat a break. So if we have some questions or, any other stories, first time real estate investments or whatever, I'd love to hear you guys and what you got going.
I can give you a little bit of a story. So I just tried one house that I was renting, my house. And I started out just doing it on my own. Then when I got the midnight phone call that their toilet was stopped up, I said, okay, let me try getting a property management company. So I hired a property management company to come in and do it, take care of it, and got the house next year. I had to rip out all the carpets, repaint all the walls. There was a bullet hole in the roof. I don't know how that got there or what that was. So I was like, okay, well, let's go ahead and redo all that. Next set of tenants come in, they go and put some crappy above ground pool in the backyard. They just again, I had to replace all the carpets, all the paint. I'm like, okay, I'm out.
Yeah.
So
yeah.
I the passive, part of it just sounds so nice, where you don't have to worry about all that stuff.
Yeah.
So
well, and that actually that takes me to my first real estate foray. We invested in what was supposed to be a turnkey single family home. And we did that right before I invested in the first apartment syndication. So it was kind of in tandem, and it was supposed to be turnkey property, like I said. And basically, everything's supposed to be done for you in that instance. You're supposed to have the property management set up, and they're gonna get it rented out for you and all this stuff. Well, I learned a lot of things from that, because I learned that turnkey is not always turnkey. And it's so important to do that due diligence where you are really researching, the people that you're working with. And so I didn't do a good job of researching the people who were selling me the property. I didn't do a good job of researching the property management team. I ended up having basically the property was vacant for almost a year because we had such problems with the property management team. And there was like a coup within the property management team where the person who thought they owned it all of a sudden didn't own it, and she was thrown out of the business. And I'm sitting here like, well, that's great, but my property's still not rented out. I don't have any leads. I got to find somebody. We had an AC unit stolen out of it because it was vacant. And of course, insurance doesn't cover that because it's vacant. So we had to pay for the new AC unit out of pocket before we ever had a tenant. And, and then we had, after 1 year, we had the turnover, and, and the resident that we had in there didn't take good care of the property. They had kind of trashed the place before they left for no reason. There was absolutely no reason, but they just took, they didn't take good care of it. And so we had to do a lot of repairs and to get it back up to snuff. And, so that being said, if we're breaking even on this property, I think we're lucky right now. I don't think we're actually even breaking even yet.
So you still have it?
We still have it. Yeah.
Okay.
And we're getting paid now because we do have another resident, but to say that we've actually gotten back to even, I don't think we're there yet.
Yeah.
But that being said, about a month later, I invested in my first apartment syndication. And 3 months after that, I had gotten my first, check in the mail for a distribution. So I was making money on the apartment syndications well before I ever made money on single family property that I had. And that's that one property, that one unit has been more of a headache than the hundreds of units that I'm a part of as a passive investor. I don't even have to worry about those units most of the time. And that was true for the pandemic too, you know, because again, these properties, they have a built-in cushion. You know, if you lose some occupancy, that's okay. They're still making money for you. You know, even if you drop from, you know, 95% occupancy to 85, that's okay. So it's worked out well for me. And that was, you know, when we first started getting the checks in the mail, it was like, oh yeah, okay, I'll do this again. You know, like this was great. So, and you don't have to deal with the bank loans. That's the other thing. You don't have to deal with banks. You don't have to deal with any of that stuff. You just, you know, basically are looking over the paperwork. You sign the paperwork and you wire the money over. So it's pretty nice. But for those of you who are new, one of the things I always suggest is that, you know, you get to know several different operators in the space. It's easy to find people who are working in the space. I mean, you know, like I'm working in the space. Nathan's working in the space. You know, like there are people in all kinds of meetups, and you can develop relationships with them really easily by attending nightly meetups or daily meetups, whatever the case is. You know, and so that's something that you can do that's pretty easy. But I suggest, you know, one of the things that I did to diversify my risk is, you know, I had these initial investments. I had 6 initial investments. Well, they were with 3 different operators. So I didn't go with just one operator and that's the only person I invested with. I went with 3 different operators, because if something's happening with that company, with that business, I didn't want it to bleed over into all of my other investments, you know, so I diversified my risk that way as well. So, Erica and Michael, I'm going to pick on you a little bit. Have you guys done any kind of real estate investing? I'd love to hear.
Not
at all.
No?
No, not for me.
Okay.
I'm sitting on a massive house in South Africa. I mean, like a personal house, but I've only been here for a little bit. So again, you got to start somewhere, but you don't really know where.
Yeah. Well, so I think the thing to figure out is kind of, you know, how active you want to be in some of these investments. So, you know, if you're looking for just straight up passive income, then what you need to do is you need to have education about what you're investing in, and you need to have the money to invest. You know, if you don't have the money to invest, then you need to get the education, and you're probably going to have to put some hustle into it. You know, you're going to have to do some legwork. You might have to join some of these operating teams. Maybe they need some help with acquisitions. Maybe they need some help underwriting deals. Things like that can help get you started. You know, and once you get your foot in the door, then that can help. But, you know, again, that's more of an active role. So there's, you know, that may not be up your alley. If you got a W-2 and you're like, you know, job or, you know, whatever full-time job, you may not be interested in that. In which case it's like, okay, well, then work on that education piece and start saving the money so that you can invest, and try to find operators who, you know, possibly have a lower minimum amount. A lot of investments that you'll see in apartment syndications are 50,000 minimum. That's not the only ones. You know, there are some out there that will allow you to come in with 25. There are self-storage investments that you can come into. Those are much smaller capital raises, generally speaking, than a lot of the huge, you know, multifamily deals. So they're willing to take on lesser amounts because they don't need as much to get to their goal, you know? So it really just depends on, you know, kind of how you're wanting to get started. So, you know, I'd love to hear, you know, kind of what you guys are thinking about as we're talking through this. You know, what are your thoughts on how, you know, what information you need to help you out?
Yeah, that's interesting that you brung that up. Me and my wife, we're still working at W-2, but we didn't have the capital to passively invest.
Mhm.
So we joined networking groups and multifamily events, and met up with quite a few of investors,
Mhm.
and ended up by being mentored by them, and so we're actively investing.
Mhm.
So
Well, and that's, like
what we're
for
shooting
me,
for.
I ran out of capital at some point. Like I don't have endless amounts of capital to invest, and so, but I still wanted to be a part of some of these deals. So, I started building an investor base, reaching out to my
Mhm.
network and talking to people about investing in these deals. Because if you can come to an operator and say, hey, you know what, I can help you raise money. I have investors that want to invest in these kinds of deals. Then that's something that can get your foot in the door without having to necessarily supply your own capital. So you can use
Right,
other people's money in that way to get into offerings that you otherwise wouldn't be able to.
right. That's
Um,
also one thing that we're working on
mhm,
is capital raising,
yeah.
and then we're also talking at brokers and getting deal flow and underwriting them.
Yeah. Yeah. And I will say capital raising's hard. It's not easy. Because you're asking somebody for, a
Right.
huge chunk of money. But that's where it comes down to building that trust through the networking and relationships. So,
Yeah.
but and Erica and Michael, I believe you guys said you kind of are wanting to be more passive with this, right?
No, I work from home and I write down schedules. So,
Oh, okay.
I am not afraid to work, and then time is time. There's plenty of that.
Okay. Well, that's
It's
cool.
just I'm pretty new to Raleigh. I don't have a massive social connection because COVID didn't do us any favors,
Yeah.
and moving
Yeah.
from Miami to Raleigh doesn't help either.
Hmm.
And it's just to see what's out there.
Yeah.
I'm also not a spring chicken anymore. Doesn't look like it, but you got to start somewhere. and most of us come from a history of working and swapping time for money.
Hmm.
You do a 10 to 11 or a 9 to 5, and you have a weekend, and that doesn't work anymore. I mean, I've only been here for a little bit, and most people have some form of pension or 401k, and that today means nothing anyways.
Hmm. Yeah, no, I agree with that. It's
You've got to diversify your portfolio and see what's out there. It's just a matter of, I'm at this point looking at what's my options.
yeah. Well, and the mistake that a lot of people make when they're in these W-2 positions is that, well, I'm going to just put my money into the stock market and I'm going to give it to my financial advisor and they're going to take care of it. And, I'm going to just work until I have enough money saved up and I can retire. And, the problem with that is you may not get the choice in that. I mean, I know my own mom, and I may have told this story on this meetup before, but my mom had, basically end-stage renal disease that forced her to retire. And luckily she had worked in a government job for 30 years. So she actually did have a nice pension, but not everybody is that lucky. And she also didn't get to choose when she retired. She had wanted to work a couple more years, because she enjoyed her job and what she did, but she didn't have that choice. Her health didn't let her. So we're not guaranteed our health. We're not guaranteed that time. But, as far as, getting more active, one of the ways to do that is to really get into some of these networking meetups. There are networking meetups that happen during the day. There are a ton of them at night as well. Once you start going to a couple of these, you'll find people that are in these that have their own meetups or they're, and Eric, I can certainly, I have, I can find a meetup a day for you that you could go to. And, it's in the middle of the day. It's not, not going to mess with your evenings and stuff. But, that's a great way to start and you can get to know people that way and start to make those connections, that allow you to get to know the people in the space, get to know the markets they're working in, and you can see how people fit. There's obviously, there are mentorship programs out there. You can get coaching. You can pay a lot of money for that. Some are better than others. paying for that kind of mentorship can accelerate your process. But for some people, they'll pay that money and it doesn't necessarily work out. And it doesn't necessarily speed up their progress. It still might take them a year or two to even get their first deal. So, it really depends on the kind of effort and work that you put into it and how you want to grow your own portfolio. So I'll leave it at that. I would love to connect with you and get you those meetups, and that way you can kind of start down your own journey. So I'll invite you to some of those. There's a great one on Fridays, the TGIF meetup with Brian Briscoe. There's Marvelous Mondays with Angel Williams. That's at Monday. That one's at noon. The one with Brian Briscoe is at 1 o'clock on Fridays. And all these are Eastern Standard Time. So went to one today. George Roberts, has a great one at noon. CRE networking at noon on Wednesdays. So there are all kinds of different meetups where you can just go and meet people who are working in this space or looking to break through into this space. And, because it really, like, it amazed me when I first got involved, like how open people were about what they do and like wanting to work with other people and, find, there's plenty of space for everybody. There's plenty of properties out there. There's plenty of success for everybody. So it's just about finding your own niche and going with that. So, but Erica, I don't know if you put your info in the chat, but would definitely love to connect with you offline. So if you want to, put that in the chat, or, you can obviously connect with me. For those of you looking to save the contact information in the chat, you can click on the little 3 dots in the lower right-hand corner to save that chat. And that way you can reach out to people here. And I believe I've reached out to everybody that has put their information here. Let me make sure, because Cinto was here earlier. I think, I'm already connected with him. Good. So I know he didn't talk much, but that's okay. Sometimes we can't always talk. We just have to listen. So,
Yeah,
all right.
Right. Thank you.
Yeah, absolutely.
We've all survived COVID. But I come from the cruise line industry. I mean, when they said the ships don't sail for 30 days, they just didn't sail for 2 years.
Yeah.
There was no going back. We're all at a point where it was a massive eye-opener for many people. And it's time to diversify and become creative, but not kind of bend the rules and think outside the box.
Yeah, absolutely. And that's really what I've been trying to do, because even just in the last, 2.5 to 3 years since I've been in this, I've really seen an explosion in multifamily. Like everybody is looking at this now. And I think, COVID had a lot to do with that, but everybody's looking at ways to produce passive income or at least some other kind of side income. And so there's been an influx of people into the multifamily space. Now, with that being said, what does that do? That increases competition. So it's not like you can, it's the same way, 10 years ago with the fix and flip stuff. You used to see HGTV shows all the time about, flip this house, flip that house, flip her house, whatever. And now it's like, well, you can't do it the same way anymore and make the numbers work, because you can't just go and find foreclosures on the courthouse steps anymore and you be the only bidder. Now you're bidding against 10 other people. And it's the same thing in multifamily, with more people coming in and more institutional money coming in, that drives prices up, and it makes investment numbers a little bit harder to work. So we're seeing some of these investment numbers, not look as good as maybe they did 5 to 10 years ago. That's okay. There are plenty of other places to invest. It doesn't have to be multifamily to work. Industrial real estate's a great option. Self-storage, senior housing, mobile home parks, RV parks and campgrounds, you name it, you can probably buy it. There's so much out there. And so what I try to do for my investors is I try to get ahead of what the next wave is. And that way, I'm providing those great opportunities. You know, in self-storage alone, 2/3 of the properties that are owned in self-storage are still owned by kind of mom and pop operations. You can't say that about multifamily anymore, but you can say that about self-storage, which means that there's more room in those investments to come in and really create a more efficient process and streamline things so that you have better profits. There's more meat on the bone with that. And that's really what I'm looking for as an investor. And as a passive investor, is I'm looking at those investments that have a lot of meat on the bone. I was working with an aspiring investor, and she sent me a deal, and I won't say who it's from or whatever. I don't want to, you know, say anything bad about anybody, but you know, a reputable firm, and they do fine work. But they advertise their offering as a value add property. Well, it was a Class A, property that was built like a year ago. You're not going to value add to that. Like, there's nothing to value add. It's brand spanking new. Like, you're not going to go in and renovate the units. You're not going to go in and, you know, provide all kinds of new amenities. It's already Class A. You already provide all the amenities. You're not going to add any new amenities that they don't already have. What that investment was banking the profits on was the appreciation of the market in which it was in. That was it, you know. But that term, like I said, with, you know, underwriting, well, everybody says they do conservative underwriting. In multifamily, every investment is a value add opportunity, every investment, but it's not true value add. Value add is when you see a situation where you can go in, update the interiors, or add some kind of value to the property by adding a playground, adding a dog park, adding this, adding that, you know, places where you can start to add value to residents' lives to where you can justify bumping rents. And that's outside of the general appreciation of the property itself. That's what a value add is. That's what value add means. But a lot of people will just slap that onto an investment, and people will buy it because I'm buying a value add asset. And it's like, no, you're banking on the appreciation in this highly, you know, appreciating market, which is fine, but let's call a spade, you know? And so that's the kind of stuff I look at when I'm looking at an investment, you know, and so I'm looking for that value add. I'm looking for the meat on the bone for whatever investment that is, because that means that will bring my returns up that much more. And that gives me that much more wiggle room with, you know, those break-even points and everything else. So Nathan, I'd love to hear what, you know, I know you said that you're in some different markets, man. What kind of things are you seeing on the ground?
We've just been networking with other people and talking to brokers, but we're mainly getting, we're getting some off-market deals, but most of them we're just looking at online. But mainly right now we're just coming across properties that really the only thing is just increasing rents, which I'm not, like you said, I'm looking for more value add, not just raising rents.
Yeah.
And so that's what we're currently seeing.
And that is, I think that is getting tougher in multifamily because you have fewer, you know, properties that, you know, hey, you're running into it and it's, you know, it's only been owned by a couple of different people in the past and they haven't updated it in 15 years or something, you know, like you're seeing more properties that are going through this investment process, and the operators that just got done with it, they try to leave a little something for the next set of investors to come in.
Right. Yeah. But I was walking a property last Friday in Louisville, Kentucky. It was I think it was 46 units or something like that, built in like the 1920s, which is way below our criteria. but
Mhm.
there was some people that we knew that wanted us to or for me to walk it for them, just because they're from out of state. So I said sure, and but I mean, like it's 1920s at like a 4% cap with
Mhm.
no value add except just raising rents. I'm just like, this isn't.
It's not gonna work. Not gonna work for me.
Yeah, I'm like,
Yeah.
it's gonna be high maintenance, and I'm like, this. I mean, it's up to you all, but I mean, like,
Yeah.
it's not something that I would be investing in.
Well, and again, it depends on your specialty. And I go back to the operators when you were asking about what I look for in an operator. So not only do you want operators who have a good track record, but you want operators who have a track record in the specific type of property and business plan that they are currently offering to you.
Yeah.
So if you've got an operating, company that they've been primarily working in C-class properties, that true value add, and now they're offering you a Class A asset, then that might be a problem, because they may not be as well versed in being able to actually handle that type of a property. You're dealing with different types of residents, different types of problems, different types of amenities, all that. So that would be the issue that I would have with, maybe investing with them. If they're offering you that kind of an asset, it's like, well, can you really take care of this kind of a property? Who are you getting your advice from? Where's your mentorship for that? Because I see that you're doing very well in the C-class space, but you're making a jump here. So that would be, something that I look at is, you want to make sure they've worked in that space. If you've got somebody who's worked primarily with B+ assets, but now they're doing a ground up construction. Okay. Well, where are you getting your experience from? Or like, what led you to take this route, and who are you leaning on? Because obviously you don't have that experience. So who is that core part of your team who does have that experience, and what does that experience look like? So those are some other things that I look at when it comes to operators. Angel,
sure.
Good to see you. Oh, hey, Jason.
Like, damn, Jason.
Yeah, well, I mean, I see the shadow now, which is a little, that actually reminds me of the Robin Hood Men in Tights scene. I don't know yeah, I know. I'm reaching way back here. I know. I'm showing the age.
We're men
and in tights. Anyway, yes, that is recorded for posterity.
You meant the sword scene?
Yeah, the sword scene.
Bazinga. See ya.
Yeah, I started singing. The night is young and you're so amorous, and I started singing that to my oldest daughter, and my wife was like, "You can't sing that to her." I'm like, "Okay, fine, I won't." I understand that might be, might not be appropriate, but anyway.
Fun stuff.
Now that I completely silenced the room. Oh, speaking of which, Erica, when I mentioned Marvelous Mondays with Angel, this is Angel. So she is a multifamily syndicator out of Texas. And she does, yeah. So she does all this stuff. She's amazing. And yes, see, and she even has a halo to prove it. So, but she's awesome, and has all kinds of educational materials as well. So definitely somebody you want to reach out to when it comes to the meetups and things like that, getting more involved in this space. Her meetup is great on Mondays to get into as well. And you can learn a lot from there and get a lot of those networking opportunities. So
definitely will do that. Thank you.
Yeah.
I know you've got a tough crowd today because we're not really talking, but I have nothing to say because I'm just learning. Like, I have no idea.
That's okay.
I'm learning. I won't even find my house without a GPS in my car still. So no idea, dude. In Raleigh, you would drive in circles.
Yeah. So. Raleigh's confusing. Don't feel bad. Raleigh is a confusing city to drive in. So don't feel bad at all.
Yeah, I'm just saying. So at this point, I mean, your crowd is stuff. We're not talking, but I'm just here to learn. So if you can really link me with a couple of people and go to them, that would be awesome.
Yeah. Well, and Michael, I know you said you're kind of just learning too. So, and you haven't really invested much in real estate. So, just what kind of what kind of way are you looking to possibly get in? Are you looking to take that more passive route, or are you looking to possibly be active as well?
I don't know. I'm just looking at
Just
information right now. I mean, I'll take a look at your YouTube videos and the podcast and stuff and see what I can get from it, and
Cool.
decide if that's something I want to get involved in or not. I'm just kind of looking
Yeah.
around. I was involved in the stock market some over the last couple of years, and they're okay. But early this year, the stock market was not doing so well, so I kind of pulled out of that more than I had before.
Yeah. Well, I'll tell you too, my podcast, I interview people that are into all kinds of things. I mean, it's not just real estate. It's not just, one thing or the other. They are legitimately into all kinds of different side hustles. So, if you're just looking to explore some stuff, I've got a good options trading episode in there, and all kinds of stuff. But I go down. So the premise of it is I interview other healthcare professionals who have their own side gigs and have them kind of explain how they got into it and what it's like to be in that particular side hustle. And so the other episodes I do mindset episodes and I do rabbit hole episodes. So mindset, that's self-explanatory. The rabbit hole episodes, I take a particular side gig and I dive into the rabbit hole and see what it's like, how you can get into it either by passive or active means, what it looks like to be in the middle of it, what the startup costs are, all those kinds of things. So, so yeah, take a listen, man. Glad to have you. And, so we all have a lot to learn. I'm still learning every day, with regards to this, with multifamily investing, real estate investing in general. I'm networking all the time to try and meet new people who have experiences outside of my own. And that's really what it's all about. So, but yeah. And so Angel Angel mentioned Yona Weiss. Yona Weiss has a great meetup as well. I'm telling you, there are just so many different meetups. Like I said, there's one every day of the week now that I can go to in the middle of the day, which is pretty cool. Didn't always used to be the case, but now you can go to one in the middle of the day, every day. And then there are a ton of them in the evening times as well. So, well, that's, I mean, someday I get it when you're in some of these large meetups, it can be kind of daunting to talk and kind of share your stories and it is nice though that some of the larger meetups, they do actually have breakout rooms so you can have conversations. I haven't really had breakout rooms in mine because we typically have groups about this size, so there's really not a need. But Angel, like your meetups, you typically have 20, 30 or more people, so that's, well, I mean, not every time, but sometimes. So we have breakouts and it's fun because you get to have these, conversations with 3 or 4 people and kind of get to know each other a little bit better, see if you vibe and go from there. And
Angel, you might know too, I think Nathan might've been there. They were saying some different conferences that were coming up. And there was one, I think in Charlotte in June. What was that?
June 23rd through 25th, there's 2.
Okay.
Dan Hanford is doing his first live event, and Andresa and Liz are doing their first Invest Her Con.
Okay.
So Multifamily Investor Nation is Dan Hanford's group.
Mhm.
And that's where he's kind of got everything together. And he's got, if you want to see some deep dives on some deals, you can look up the Multifamily Investor Nation Summit, and they have a couple of, different years worth of conference podcasts there. They are dated, like it's been a couple years now, but super in depth, and you can learn a ton from those deal examinations. But yeah.
Well, I had it in my tabs at one point on my phone, so I was looking for it. It's the 23rd through the 25th, or the 22nd through the 24th.
Yeah, I don't remember offhand because I'm gonna be out of town. So I would go because it's so close by. It's like, oh man,
Right.
I hate that I'm missing it, but I don't, because I'll be in Switzerland, so I'll be all right.
Oh,
Yeah, I know. Tear. Everybody's
for you.
crying for me. Yeah, it'll be my kid's first overseas trip, so I'm pretty stoked about that.
That'd be awesome. Where are you going in Switzerland?
So we're starting off in Zurich, and mainly Schaffhausen. We fly into Zurich, but we're going to stay in Schaffhausen for I want to say a little less than a week, and then we'll be down in Meiringen for the remainder of the time.
Are you a watch guy?
I am. I would love to check out the watches down there because I haven't gotten a new watch in far too long.
Where are you
So
going?
Switzerland. So
Okay.
Jason, who's based in Switzerland on watches?
If you, I'm a watch person. I actually went to Tag Heuer training in Neuchâtel in Switzerland like 2 or 3 years ago.
oh wow.
But these famous, massive international brands of watches actually have tours you can go on. They do it once a year or twice a year. You just got to pre-book. And then you can go and see and go into Panerai and Breitling on one day. And then the Sunday you're going to Panerai and going to IWC. And there's a whole 2 weeks tour where you can actually go and tour the watch and you can have a personal tour, which is amazing. Or you can contact them directly and just some of them have a museum or a space you can go into and you can do a tour as a regular person from the public.
Oh, that's really neat. I'll have to. I hadn't even, I hadn't even thought about that. We of course thought about the chocolate factories and the, cheese making and all those kinds of things, but I hadn't even thought about watchmaking. That would be incredible to see.
Jason was just saying it's like Rolex, Tag, Tudor,
Tag Heuer, yeah, and
Breitling, Panerai, IWC. I went to
No, I thought Breitling was out of the UK.
No, I went past their factory 3 times. I couldn't go in. You know how much that hurts?
Some of those watches, I mean, like I'm a watch guy, but I'm not like I'm going to spend thousands of dollars on a watch guy. Like I'm not at that realm. But would I love to go tour a factory that makes those kinds of watches? Sure.
Yeah, I went to Hubler and Tag, and Tag's got 4 factories. So we watched them.
Yeah.
They did the whole tour and built to watch and everything. It's really cool.
Yeah.
For yourself.
I'll have to check that out. Yeah, for sure. That's a great idea. Thank you.
It's like the whole trifecta's there.
Yeah.
So it's like
Pretty
Constantine Vacheron, Vacheron, Constantine, Paddock, and AP.
Very cool.
Okay, when I'm big on the AP.
So I'm wearing a Seiko. I don't know if that, it's not in Switzerland.
Jason said that's Japanese.
I know. I'm just messing, but I'm like, yeah, I'm a watch guy. Yeah. But yeah. Anyway. So yeah. Well, anybody got anything else to add? I know we're kind of a little bit past time, so I don't want to keep people from their other things.
I found the thing too. It's June 23rd, 24th, and 25th because the multifamily conference, the live one of Dan's and Investor were at the same time.
Oh, okay.
All right, so I looked up the Investor. That one's really expensive.
Then you don't want to look at the other one.
Okay, I won't.
Because theirs is only $800, right?
I think maybe now it's over, like it's 900 something. Yeah.
Yeah, you don't want to look at the other one then.
Okay, I won't. I know.
I think it's 15.
Okay.
What's the
Next.
I'm gonna look it up real quick. I'm not even gonna say anything else. I'm gonna look it up because I can find it faster if I just
Deal makers early bird at 3.
Yeah. What is it? Vertical Street Ventures.
I haven't looked at theirs either.
VSVCon National Conference, June 4th and 5th in Scottsdale, Arizona. And then I want to say they have early bird registration. It's only like $100 or something. And they have some pretty good speakers. I mean, they got Kyle Mitchell, they got Bronson Hill, Hunter Thompson, Jenny Gu, or Gao. Is it Gao? Gu?
No idea.
Okay. I know the name. I mean, I recognize your face and I recognize the name.
It's GHOU, isn't it?
GOU.
GOU.
Yeah, GOU. I was expecting Jason to pipe in and say, it's Japanese.
He's taking care of the girls.
I don't know. Anyway, but yeah, they seem to have some pretty good speakers and so but anyway.
Yeah,
so but that's in Scottsdale if anybody wants to travel.
Ultimate Partnering is in October. And it's under 5 and it's like buy one get one.
Mm-hmm.
Okay.
So, and for those of you who are like, I don't know about all these conferences. So when you start to actually, connect with people in multifamily on LinkedIn, these things will become your feed in LinkedIn. Like that's what happens is you just get all this multifamily stuff. So the more you start to get into this, the more that information will just start to flow to you more naturally. So don't be alarmed. I was thinking, oh man, we need to put that link in the chat. We need to put this link in the chat. No, you don't.
So like this one's from today. The guy in the front is from Israel. And he was at an event, and in the background is Abel Pacheco, Jeff Hawk, my friend Sandia Shashadri, my friend Nick, and then me. And Jamie had only met any of us on LinkedIn and on Zoom events. And he flew from Israel to be at that event.
Yeah, people have they've only met each other on some of these networking calls over the last couple of years. And so now that we're having in-person conferences, like I'm excited to go to one because I'm excited to legitimately just meet people in person for once, instead of just seeing faces. So, but anywho, so any last questions, anything, burning desires? Seeing a lot of nodding heads. So, well, it has been a pleasure having everybody on tonight. I really appreciate it. Definitely, reach out to me whenever, however, and I'm more than happy to help anybody out in their investing journey and with any questions they have. It's been so great having all of you on tonight, and I've really enjoyed the time with everybody. So, for those of you who are new, we'll get you going here and get you into the space a little bit more and help out with your education. So, and also I would be remiss if I didn't mention that I do have a free educational email series. I'm not good at plugging my own stuff. But if you guys, I'll reach out to, Erica and Michael on LinkedIn. If you guys want to just shoot me your email address, I can put you in to my investor list and I'll get you that free email series because it breaks down things pretty nicely. And it's a nice introductory series for multifamily and alternative investing. So if you guys want to do that, I won't ask you to put it in the chat here, but you guys can just, shoot it to me on LinkedIn and I'll get you those emails going. And then you'll have access to my newsletter and stuff. So that's pretty cool too. So, and the others, Angela, Nathan, if you guys want to be on my list too, that's cool too. I'm not trying to, tell you can't get this stuff, so you're welcome to it. Just shoot me your email. But
sure.
All right. Well, I don't have a song and dance to get us off, but it's been a pleasure, guys. Thank you so much for being here.
Thanks a lot, Bob.
Thank you.
Y'all have a good night.
Thank you for
Thank you so much for joining me for another episode of the Plan B CRNA podcast. If you haven't already subscribed and reviewed the show, I'd be honored if you took the extra time. It really helps to expand our reach and get the word out about the show. If you're a CRNA who is interested in sharing your story on our podcast, I'd love to have you. Please email me at bobby@oncallinvestments.com for more information. This episode was brought to you by On Call Capital. They are dedicated to helping providers like you develop passive income and generational wealth through investments in the apartment and alternative investment spaces. Feel free to check out their website at www.oncallinvestments.com and subscribe to their free educational email series. You can find On Call Capital on Facebook, Instagram, and Twitter. You can also check out our YouTube page, where you'll find all of the show episodes along with other educational videos. Thanks for listening, and we'll see you on the next episode.